happened from the beginning of April, actually even a little earlier, if we're being honest, was that we shifted from, reasons for everything to be negative, ways to shape news in a negative, ways to shape earnings to negative, looking for reasons to sell and be bearish, to now looking for reasons to be bullish. So even though it's news driven, it's chaotic, and we will get some back and forth. I think the overall emphasis is looking to the upside. Hold on, let me take this call. This is Graham. I think he lost his internet. Graham has indeed lost his internet. So he's gonna drive over and try to reconnect. I think he's gonna go to another spot and be able to log on here in a couple of minutes. Um, I already forget what my point was. Oh, just that the news, even though it's news driven and it's chaotic, there's still a sentiment behind it. We're using that news to get us where the market wants to go. And I think that's kind of an important underlying feature of what's going on in this market. I texted Graham last night. I don't know what it was, like 10:30 or 11 o'clock. I said, dude, I wish I had the ability to buy zero DT puts right now with the NASDAQ up 2.2% or whatever it was. Just feeling like the fade was going to happen, whether it was 1.5%. Just seemed like the most obvious fade in the world because, of course, you're going to have that overreaction of, yeah, the tariffs are blocked, no more tariffs ever again. And then you're going to have some settling back. Okay, well, actually, we're still going to do tariffs here, and we're still going to appeal this, and it just seemed like one of the more obvious, kind of settling opportunities from a reaction. So, kind of bummed that I don't have the ability to buy puts at 11 p.m. But oh well, we got the fade earlier in the market. Now I think we're kind of back to a reasonable point. We'll see what the market does. I think today will be a good day to see it kind of shake out. Maybe not the most active day for me, just kind of seeing how it actually digests and shakes out. But I think now we're kind of back into a reasonable spot. SPY's about 0.6%, so positive but not running away. Q's back down into that range as well after being up 2%. The big one, the big fade was on small caps. Let's see. Let's flip over. I'll share my screen here. So here's IWM. IWM, we got a really big shoot up here to about two. I'm on the 15-minute chart to about 207. So, market was closing here. Um, let's see, what do we end up at? Let me find it. If I can find it on a 15-minute chart. Here we go. Okay, market was closing at about 204.90, 205, no, 205.90. We shot up to about 208, and then are now back down. We're only up 0.3% on the day. So small caps had a really positive reaction there out of the gate, thinking, hey, tariffs are going to be, great for the small business, which, by the way, I would agree. If you cut the tariffs, small businesses are looking for an outsized advantage because, the bigger the company, probably the easier that they can withstand the tariffs. But that faded right back down, kind of like what I was talking about, just expecting some nuance there in what a big announcement comes like that. Apple's the other one I think that's quite interesting. So Apple also big pop here. Here's the close. Big pop here. I don't have my extended on. That's why you can't see the full pop. There we go. That's more like it. Okay. Big pop there. 207, 208. Got up to 207.90 on Apple. So what's that? About 3.5% on Apple on that rip there. And then we're basically centered back out at yesterday's highs, or even a little bit lower than yesterday's highs that quick. So some of these fades are interesting. Apple is one. that I actually put in the buy category now. Like I said, overextended for sure, or overreaction for sure. Now I think we've had a double overreaction. I like Apple as a buy right now if you like short term trades, and see if we can get back up to kind of the midpoint here between 208 and 201. So like a short term trade up into the 204 range for Apple actually makes sense to me, because I think the news genuinely is good for Apple. Like I said, there's going to be, hey, we're going to appeal this. We're still going to do tariffs here. We're still going to do X, Y, and Z. That kind of stuff's going to happen. And as that happens, you might see Apple kind of get whipsawed around. But I think the net impact should push Apple actually up a little bit. So kind of an overcorrection to the upside. Now I would consider it an overcorrection back to the downside. The last one I want to mention here is NVIDIA. Some of you guys took either Graham or I's trades from NVIDIA. Pretty safe right now, still up, 2% or so above where our line in the sand was. I have a more aggressive trade that I'm going for 145 on NVIDIA, but I have until next Friday for that one. So I still have 8 days on that one. Already up about 70% on that trade as well, but I'm going for a whopper on there on NVIDIA. So it'll be interesting. Like I said, today I think is going to be a digestion day. Let's see what the market actually does with this news. Whether it thinks, that original reaction was, overbaked. What doesn't make sense to me, and we'll see what the market does. Sometimes you get a news announcement like that, you have an initial positive reaction, and then you get an overreaction back to the negative side. You actually put a red day on the board, which actually makes no sense to me. And those are oftentimes when I like to buy at the close, because at the end of the day, even if they appeal every bit of that, or, it ends up being majority non-consequential for the main tariffs, it still has a bit of positive impact to it. And the only reason that you get those red overcorrection days is purely from like a liquidity, market reaction standpoint. So if we get to that point, which I don't think we will, but if we get to that point where we're sitting here at 3 p.m. and we actually have a red day on the board, I like some overnight buying opportunities, because I think that just, again, overreaction to the upside, overreaction to correct that upside, and then probably somewhere back into the midpoint of those two high and low prices is where we'd likely end the week if that happens. So a couple things to watch for there. I think, right now in the immediate term, I'd like to just see how this digested over the next couple hours and what we get. But, like I said, it's that whole news-driven market is not a cliche. It's a very real driver for everything we're seeing right now in this market. NVIDIA actually dropping right now back into the 130s. So we'll see what we get here.
Hey guys,
Oh, hey, Graham.
sorry, I had my internet go out randomly with 3 minutes to go before opening playbook, so I had to run over to a neighbor's house and get set up here. Let me go ahead and pull up my screen.
By the way, hello everyone. Chris, David, I get to say hi to everyone. Chris, Dean, Mike, Greg, Babette, hello. Carlos, Rafi, hello. Russ, how are you? Danny, hello. Bob, hello. How's everyone doing on this lovely Friday?
We are seeing. I saw someone post about Oklo in the chat. Oklo's
Oh,
down 2.5%. GEV's down 4.5%. This looks
that's
scary. If you guys watch the overnight market though, GEV popped all the way to 500, which is again, oh actually 510, 515. I think we're seeing some profit taking right now. I am not worried about it. I think it's very natural when a stock has gone up 2% every day for the last 3 weeks in a row. It's okay if it has a quick little profit taking session here. Same can be said for Okla. I mean, the stock has doubled
yeah. I mean,
practically.
2.5% on Oklo is
Yeah.
a nothing burger right now. We'll see what happens. GEV a little more significant. It was what it was it 515, so it's actually down like a true 10%
Yeah.
from the highs.
Yeah. And that was in the overnight market. I mean, during the day, we saw, what is this, 585 or 485. So it's overnight, big time news. It looked like GEV was they had some sort of news come out with their SMRs with the U.S. government. So that could be a really cool thing if they get some contracts landed there. A lot of room for growth there. Now Kramer did say that he likes GEV better than Oklo, which makes me worried since I have more than Oklo. But I like them both.
Gotcha. By the way, guys, if you like Apple as in terms of thinking maybe it's a little overcorrected, uh, undercorrected. I'm not sure what the right term is. Undercorrected now from the bounce and then the rip back down. Fun little trade you could take is just buy a spread like in the 197.50 200 for tomorrow, and basically say, hey, I think Apple's at least going to hang above. It's not going to go down another 0.5%. It's at least going to stay positive over the next 2 days from the news. You can make probably 15-20% on like a defensive trade like that. So something like that, would be a fun little trade on Apple that still gives you some room for error here. Basically, what you're saying is maybe the news isn't positive in a way that's going to drive Apple up 5%. But if all Apple does is stay sideways from the news, I'll make 15-20% of my money with a pretty defensive trade. So that's the kind of trade you could take. Couple of different opportunities like that we could look at if you're like me and you think, we'll probably net out somewhere around the slightly positive range when this all shakes out.
Yeah. All right, Nate. Well, I missed the first 5 minutes. What all did we cover? Give me a quick recap.
Just kind of the news and the initial reaction. I mentioned curious on your thoughts on small caps. Small caps were the most overreacted and then overcorrected
Mhm.
out of the gate. Seemed like and I haven't actually read a whole lot yet this morning, but it seems like the obvious would be, hey, if tariffs go away, that helps small cap companies exponentially because they have the hardest time dealing with them in the get go. And now, as soon as we kind of bake in some of the nuance of, well, there's still going to be tariffs here, still going to be X, Y, and Z, immediately gets sold off. But I still kind of put it in the category of maybe now overcorrected from the overreaction out of the gate here.
Yeah. I think so. I don't know. For small caps during my many years here trading, I just keep getting bit in the butt by them every time I think it's time for them to go. I mean, I've made some money on them, but really I'm to the point now. It's like I'm not jumping in until we see true momentum, until we see it actually leading the markets. I mean, S&P is above the 500-day or 500 200-day moving average. Small caps are not.
Yep.
So I'm just going to leave them to the sideline until we see some strength, some momentum building there. That's my personal take. Now, theoretically, if we do get rate cuts and everything, it should be good for the small caps. But we've been waiting for rate cuts for 2 years now, almost 2 years now, a year and a half.
Yeah. Yeah. IWM down 3% from the overnight high. So pretty big rip there back down. By the way, one thing like we've been talking about over and over again, I shared on the roundtable and on Opening Playbook. We're seeing that same kind of leading of the pack where the mags, obviously helped by Nvidia, are the strongest of kind of the main assets pulling us to a green day. So you've got the mags, you've got the QQQ, you've got the SPY, and you've got small caps at the bottom. Same kind of sequential order that we're seeing drive, that we've been talking about here for the last couple of weeks.
Thoughts on Bitcoin? Still the same thoughts. They haven't changed. I think we're in the midst of the last leg up in this bull cycle here. A good opportunity. My target's still 125 for first profits and 150K for second profits, Priscilla. But we can go ahead and get rolling here. Now, there is something I want to bring up, and Nate, I know you do too. We sent out a feedback form to you guys in Telegram, and thank you guys, everyone who submitted your responses there. And overall, very, very positive response. Very thankful for that. But there was a reoccurring theme there that felt like there was an overwhelming amount of trades that we were, doing 3, 4 a day, 5 days a week. That's, 20, 25 trades there. And it's a lot to keep tabs on, keep track of. So Nate and I have decided, based on your feedback, that we're going to try to be more selective when giving out options for you guys. So we don't want to overload you with trades. It's our goal to give you as much value as possible for you to make as much money as possible, but we don't want you to feel overwhelmed. That's not the purpose of this show that we're doing here. So I hope that's okay. CB loves the overload. We're still going to give you lots of picks.
We, we we did we did get a couple of people who love the trading. By the way, here's the form. If you guys didn't get to give your feedback and you still want to give your feedback, by all means, you can click that link in the chat. But we got a lot of people who are either newer or they've got other services or things. And keep in mind with Opening Playbook, it's a free show for you. It's meant to drive maximum value. But it's not a service in the sense that we're not going to be able to track every single trade. If you email us and say, hey, what was your entry price on this and what's the exit target? Like we might literally just not have it tracked in a way that we can share exact details because it's just one of the free trades that we did in real time versus like a service where obviously it's locked and loaded. It's we have a log timed up and all that kind of stuff. And so, that's one of the things that we wanted to make sure is that we don't actually turn it into a detriment for anyone, where they've got 7 trades opening from Opening Playbook, and we might have given some context when we open, but it's not, clear exactly what the plan is and how to manage it. And especially for newer traders and people who just want to, kind of simplify their approach, uh, having 13 spreads open might might be a lot to handle. And so obviously we want to, we want to try to simplify it in a way that still delivers the most value possible.
Yep. So we're still going to give you guys lots of picks as far as stocks that we like, why we like them. And we're still going to do all the options trainings so you guys know exactly how we trade them. And we will give you options trades as well. But again, like Nate said, we just don't want to overload you guys. So if you like the picks and you want to apply what you've learned, well, you're more than welcome to do that. Alrighty. Well, today I'm going to do a little training here on seasonality, what I look at, what I typically look at here. And I'm also going to give you the 3 top June stocks for free. As you can see here from the list, there's quite a few names here on my hit list for June. Blurred out the dates and hold times because I'm not going to give it all away, but I'm going to give you 3 of them with very specific tickers, dates to enter, when to exit, and the average return during that period. So again, you guys can take these picks, write them down, and then apply options to them based on what we've taught you or however you like to trade options there. And then we have a little special bonus here at the end as well. So thank you all for joining. My name is Graham Lindman, and today I'm going to teach you one of my favorite ways for identifying stock trends, patterns, and forming my analysis for what is to come. Now, this session will feel like a major data dump. Keep in mind, it is recorded. I will share the slides, and we are working on getting a portal together where we do have all the recordings and trainings and everything in the trades all in one place. But today, it's going to be a lot of action-packed information. It's going to come at you fast. Feel free to screenshot everything, but I will also be sharing the recording with you guys. Now, there's a saying that goes, history doesn't always repeat itself, but it often rhymes. And we see that a lot with trends that repeat or, even macroeconomic cycles that repeat, and even in individual stocks. Now, I take dozens of market patterns, seasonality factors, and use that to get a gauge on where I believe the stock market will head next. That's one of the key elements I use in that Tuesday breakdown I do that has been pretty on the money so far. So let's cover some basic market seasonality here. First off, the S&P, the broad index. We can take a look at this here by a monthly breakdown here since 1990. It's over the last 35 years, the S&P 500, and this is a month by month breakdown here. Now, there's tons of different charts you can get for this. Some are longer dated, some are shorter dated. They're all really can be helpful and good. What I would not do, I wouldn't look at a chart that has maybe 5 years of data. That's simply not enough information to form an opinion off of. We want to see something with at least 20, 25 years or more. And on the other hand, the markets are very different than they were in 1930. So sometimes you'll see a chart from 1930, and things have changed, trends have shifted. Obviously, institutions have always been involved, but now retail is involved. We can all access it, so the trends change. So here's a good snapshot here, a good rule of thumb of what seasonality typically looks like in the S&P 500, broken down by month. So January averages about a 0.5% return. February a little bit softer. March, April, May is the second most bullish 3 month period in the market. You can see that here. Then we get into the summer months and we talk about the old adage, sell in May and go away, which I don't believe in, but you can see why people say that. June is normally flat. July can be good. August and September, normally the 2 worst months in the S&P 500. And then we normally finish off the year strong in Q4 with that Santa Claus rally. Now, this does not mean that every single December stocks have gone up. It just means on average over the last 35 years, it's been a very, very good month, a very bullish month for stocks. So that's just a good place to start with seasonality. And then here's another good chart here that breaks it down in 2 week periods. So I just showed you every month. This one actually breaks it down a little bit further. So here, 1H July just means first half of July. 1H March, first half of March. 2H December is the second half of December. So you can break it down here by bi-weekly periods in the S&P 500 to get a little bit more granular information on what typically happens. And again, I have the data up here since 1950, so we've got 75 years of data here to show what is pretty normal in the stock market. So the worst times to be invested, typically speaking, is the second half of February, which we saw that this year, second half of June, and second half of September. September is normally a pretty volatile month. And no shock to see that one as the worst period in the S&P 500. Again, feel free to take screenshots. These are things I'd like to, if I were you, I'd take a screenshot, I'd put it in a Google Doc or Word doc and print it and just have a little binder on your desk with these sorts of charts and information so you can always reference back to them. Another way to look at seasonality, if we break it down even further, is looking at the S&P 500 by sector. So within the S&P 500, there are 11 main sectors. So things like energy obviously trades very different than technology, which trades very different than healthcare. So it's important not to just look at the S&P as a whole, but what sectors tend to be the best and worst during those periods. So this is one of the scorecards that I go over every single Tuesday. Down here at the bottom, you can see the average S&P return. This is since 1990. And then above this, you get each and every sector and what it typically does. Now, keep in mind, communication services is a newer sector. I don't know the exact date, but it's been around maybe 5 to 10 years. So it's a little bit less data there. But for the most part, these have been around for a while. So like if we're looking at information technology, which is your stocks like Nvidia, Apple, Microsoft, and we're looking at, May, very good time to be invested in tech versus June, not as good. Now, relatively speaking, it is one of the better ones, but you can see the difference there. May is very bullish. June is a little more flat. Let's look at financials, for example. That's one we've been trading a lot lately. March, April, May, all very good months typically for financials. However, when we get into the summer months here in just a couple of days, typically not a great time for financial stocks. Actually, it goes on a little bit of a dry period here with some chop in the way as well. And then you can see it's like a heat map. The darker the green, the better the month. The redder the red, the worse the month. So materials in September, really, really bad. Versus, let's look at Infotech in November, very, very good and bullish. Cool chart to have, cool one to review. So if we're looking at June, again, June is normally flat. We see that right here. But breaking down the sectors, it's normally good for healthcare, bad for materials, as far as the best and worst ones, typically speaking. Now, there's all sorts of seasonality that you can dive into, and we'll do a quick rundown of those today. But gold, everyone talks about gold, right? It's in all the headlines ever since its big major rally over the last year and a half. Well, it has its own seasonal trends too. And so here you can see since 1990, the average patterns that we see in gold. Take a look at this. I found this interesting. We saw that big push to all-time highs in April, which is a typically very bullish month for gold, and a little slowdown in May. Well, let's look at what typically happens in June, even more of a cool off. Now, I'm guessing if this happens right about here, everybody on CNBC and Twitter are going to be saying gold's rally is over. It's going to collapse. Sell it while you can. But if we look ahead at what typically happens late summer when the markets get volatile, right? I just showed you here, August, September, typically a scary time in the stock market. Well, it makes sense that gold typically benefits then. Flight from risk to a safe asset, if you will. So again, if we get these headlines in June, if we do see gold start to consolidate, which wouldn't shock me. I mean, it's been on in a massive rally. Well, don't write it off just yet because you know this is a typical pattern for the gold index. We can also look at seasonality, or VIX seasonality, which is our volatility index, which again just tells us how big the moves are happening or how expensive the premiums are getting on options. Actually, if you guys missed Kane's training, you should go back and watch that. It was absolutely amazing on how he covered the VIX and how to read it and digest it. But here you can see, or actually, I should say, a low VIX is a good thing. So, like, this is a very good thing for us, typically speaking. I mean, stocks are strong, steady, not a lot of volatility movement, not a lot of scariness going on in the markets. Versus a big reading, a big spike in VIX is not so good. A little more choppy, hard to get direction. Oftentimes, it means stocks are falling. So, as you can see, VIX seasonality, very, very good here. But getting late into those late summer months, July, August, September, when we normally see the markets turn the other way, well, volatility typically increases. Now, there's a couple things you could do with this. One, you can say, all right, markets typically fall, VIX typically goes up. Maybe I'll buy some put protection, like an insurance play on your portfolio. I'll buy some puts in case we get the typical late summer, early fall market drop. Another way to look at this and say options tend to get more expensive late in the summer, going into early fall. Maybe I'll start to sell some premiums. Premiums might be cheaper right here, which isn't so good for option sellers versus here. It's kind of a little gold mine for option sellers. So there's multiple ways to look at this and digest it here. And there's all sorts of seasonality cycles that we look at, we analyze, and we cover here. One of them, we do it every week, is the presidential patterns. And then, obviously, there's 4 years in a term. So there's 4 years of different charts. This one is the chart that we look at every week for this year because this chart shows the typical market cycle in the first year of a new president. So I've covered this. Hopefully, you guys know what this chart is by the back of your hands by now. This green line here shows what typically happens in the inauguration year of a president. Doesn't matter if it was the new president or if the previous president re-won the bid. This is what the S&P typically does. This red line is a little bit more important to us this year. This is what typically happens when we get a new president in the inauguration year. So very typical for the first quarter of the year to see a market shakeout. Why? Probably policies are changing, a little bit more uncertainty. No one knows what all are they going to do, how drastic are the changes going to be. And then April going through June or the end of May, really, we get that kind of bounce back here in the markets. We actually typically see all-time highs in May. Now we're not exactly on this trend right now, right? We haven't followed it to a T, but you can see, look at this, January dip, markets go up. Same thing here, dip, markets go up. February, markets hold steady, and then they dip, hold steady, big dip for us. Now here we had a little bit divergent in March when we saw the big dip lower on with all the tariff news and the Liberation Day. However, look at this. April through May, markets tend to go back higher. Look, this blue line, I should have said this earlier, is my beautiful drawing of where the S&P is this year. Dipped in April, hit the bottom in April, and we've gone higher since. So again, history doesn't always repeat itself, but it often rhymes. And we're seeing that happen right here, just a little bit on a more extreme basis where the moves are bigger in either direction. But what does this tell us for June and July? Well, it tells us kind of what the seasonality patterns show us as well. Typically a little bit slower summer months, some dips from here on the presidential seasonality. Now, if you guys have been paying attention, I've called for all-time highs in June, barring any bad news. So if we get some crazy news, war, tariffs, something just insane, I don't think we're going to go to all-time highs, and that doesn't take a rocket science to say that. But if we keep trending in the way we are with the news sort of settling, the dust settling, I think we're going to see this final May spike here that we had just come a couple of weeks later, where we'll be at all-time highs here soon. That's my prediction. But for the most part, outside of that, I'm going to be generally following this pattern. So dip late summer, all the way into October. Remember, markets typically fall August into October, and then a very, very strong Q4 for us. Speaking of presidential cycles, what happens in election years? So this was last year for us, but it's a good screenshot to keep in your little notebook there to bring it out here in 3.5 years from now, or how is it, 2.5 years when election season starts? That's crazy. This what typically happens in election year. So we will have an open field election because Trump has done his 2 terms. It'll be all new candidates, which is this red line here. Again, typically a little shakeout early in the year and some choppiness throughout the year. That's an open field election year. But this black line here shows all election years. Green line shows if the sitting president is running. That's what we saw when Biden was running. And it's funny, I don't have an overlay here. It stopped right here. I didn't draw it out, but this green line was pretty much on par until Biden ended up dropping out of the race. But it was cool to see that happen when the sitting president runs. It's typically a very good bullish cycle for the markets that year. And then if we look at the full cycle, we're going to zoom out. So here is the post-election. This is the year we're in now. Midterm, pre-election, and election year. You can kind of see the results here. The third year of the term is typically the best year. So it says the sweet spot here is buying at the end of the midterm and holding that third year. Look at how bullish that typically is. That's the S&P, the Dow, and then the NASDAQ obviously leading the way. So if you guys are taking notes here, we're about right here. So set your alarm clock for about a year and 3 months from now, and that's typically a great time to be really leveraging long stocks and equities. I'm going to pause real quick, see if we have any questions here in the chat. I know I've covered quite a bit so far, and again, this is a fire hose sort of class where I'm just dumping all sorts of data on you guys, and want you guys to soak it up.
Yeah, and the cool thing is, as we've been alluding to, we're going to try to get a members portal set up for folks and have some of these resources and trainings in there so that even on the fire hose sessions, they have the ability to go back and catch up.
Awesome. Dean says, been fishing, using what I've learned with y'all, making money, not losing. Awesome. Thank you guys. Well, we'll keep chugging along here. We had a question about Bitcoin earlier. Well, here is a seasonal pattern for Bitcoin. Now, keep in mind, Bitcoin hasn't been around for 100 years. Only about, what, 12 years, 13 years now? Actually, a little more.
A little more than that. Yep.
I
Was it 2008 or is it 2010? I always
think
forget.
2010.
2010. Okay.
But so about 15 years of data, but we do see these cycles in Bitcoin. We actually see one around election day. It's a seasonal pattern that has repeated 3 times because we haven't had 100 presidents since Bitcoin, but you can see election days typically very bullish for Bitcoin. Here's the election day 2016, bullish. Election day 2020, election day 2024. If you guys were paying attention, Bitcoin went from like 70s, the 70s to like 85 to 100 in just a couple of days. Made a crazy pop like that. We did see some consolidation, and then just recently, you can see here, normally pop, consolidation, another pop, pop. Actually, this one's probably a better picture. Pop, consolidation, pop. That's where I kind of think we are right now, where we just hit all-time highs on Bitcoin, and I think we've got the final leg of this rally to come before we get more of a crypto winter. So it's kind of similar here. Pop, little consolidation. I think we're going to get this final leg up before a crypto winter. Pop, consolidation. This one didn't actually go to crazy new highs before we had that bear market in 2022, but I think we're going to see something a little bit more like these charts here. Obviously, the gains for early investors were much bigger than what I think now. I think we have about 40-50% upside from here on Bitcoin going into that, late summer dry spell on the markets. Now, there's also, I just showed you some long patterns, right? Or like long dated. This is 4 years of a chart we're looking at here. This is like 15 years. But there's also short dated patterns in the markets that you can trade. One of them is the weekend effect, where you guys may have seen this chart before, where typically stocks rebalance on Monday. We'll see some selling, we'll see some positions moving around. The theory is that Wall Street comes back after the weekend, digests the news, and then updates their portfolio based on that. And that's why typically Monday is a slightly down day. Now, actually, over the last few years, I think last decade or so, Monday's actually flipped positive. But historically, this chart goes back to 1929. So this is almost 100 years of data. Historically, Monday is a red day. And Tuesday, Wednesday, Thursday, Friday are typically green days where the market goes higher. Tuesday typically being the best day. So if I'm looking at this chart, and I wanted to pay attention and I see stocks down on Monday, I know I can probably buy stocks end of day Monday for a discount. And more times than not over the last 100 years, sell it back Tuesday by the end of the day for a good little move here. I mean, that's an average 0.2% move, with obviously some being more extreme or not. Now, something interesting to note about this chart is if you take Black Monday out, 1987, that crash where the markets fell 20 something percent in a day, this one is actually pretty flat. So this is a little bit skewed just based on that one day in the markets. Thankfully, we have the what is that called? Tripwire. What is it? Where the markets pause, 6% drop. Anyways, came after
Sorry,
Black 9/11.
sorry, I'm not listening to you because I'm answering your size questions about opening playbook VIP.
Hmm. Well, we got to get that rolling. Does this chart generally make sense for you guys on how this is a daily view of the S&P? Stephen missed the beginning. Is this recorded? Yes, it is recorded. Or Stefan, sorry. Awesome. Another seasonal pattern you can look at is the overnight effect in the markets. What happens if you buy at 9:30 and sell at 4 p.m.? Well, here if we're looking at the S&P 500, it's pretty flat. That means that trading during the day or buying the opening hour and selling the ending minute of the day is not that profitable. It's actually not even a profitable strategy. I think it's like minus 16% since 1993. Now, that doesn't mean there's no up days and no down days, but overall, we normally get chopped during the day. The biggest moves tend to happen overnight, which means if you're buying at 4 p.m. and selling at 9:30 a.m., that's where the majority of stocks gains came from, actually more than what the S&P 500 has returned. In other words, you would have been better off in the long haul buying at 4 p.m. and selling at 9:30 than buy and hold. And that doesn't include taxes and capital gains. So I don't suggest going and doing that unless you want to stay on top of it in a retirement account. But that's just a very interesting pattern where typically, and I think a lot of it has to do with this news-driven market, where you can see it's really shot up here in the last few years. Like, I mean, look how steep that curve is. where we, earnings after the bell or before the open, we have all sorts of action happening overnight, and that's what's making these big gap ups by the time the morning opens. If we're looking at macro patterns, and actually, I've got a question here in the chat. Good question. Joseph says, "Do you think it makes it better to hold off on Mondays?" Going back here, you could do that. I actually think it's best to be buying on Mondays because you can essentially get things at a discount, typically speaking, if that makes sense, Joseph. So it doesn't mean buy the open on Monday, but it does mean by noon or so when the market's normally made their move. That typically can be a good time to be buying at a discount.
One thing too to keep in mind about the Mondays, you can do it on a scenario basis. In other words, if the market does dump 3% on Mondays, you kind of know, okay, here's one of those Monday flushes and look to be aggressive while everyone else is panicking. Because if you look at that Monday chart that Graham just showed where Monday's a red day, um, I, I wish it was like, hey, on average, this is every day. Every Monday we're down a little bit, every Tuesday we're up a little bit because trading would be really easy if it was that way. But that Monday comes from like 4 or 5 massive days, and then a handful of other ones like Black Monday being down is a huge chunk of that red bar. One day in the last 40 years makes up a big chunk of that red bar. Couple other flushes, and so what that doesn't mean that 9 out of 10 Mondays are red. Like I said, that would be great because that would make trading really easy. But what it means is that cumulatively you have the biggest dumps on Monday, and so it gives you, I would say, Joseph, to answer your question, more of an opportunity to be aggressive if the market is really negative on a Monday while everyone else starts to panic, just knowing this effect and how it actually shakes out over time.
Mhm. Awesome. Well, there's also macro patterns to consider, like the start of rate hike cycles, like we saw in 2022, right? The Fed started increasing the interest rates. Well, what normally happens? Well, everyone thinks that's a bad thing, and it can be. It can lead to a tightening economy. But typically, if you look at this, the during the rate hike cycles, S&P actually averages about 11% over that entire cycle. Now, the cycle can be longer or shorter. So, like here, we can see 1946 to 1953, pretty long cycle there, versus 1999 to year 2000. Not a very long cycle. But you can see, and we've seen it in our most recent cycle, that even with the interest rates increasing, yes, there was that initial drop from April till November of 2022. But since then, the markets have been raging new highs over and over again. So annualized, if you look at that, the average annual return during rate hike cycles is actually positive. So normally you'll see headlines, fear, recession's coming, scary, scary. Well, let's look at the numbers and see what it tells us. Yes, drops have happened, but on average, the average annual return is 4%, which is positive, which is good for us. Here's just another way to look at it if you want to just see what happens after the first hike, next 3 months, 6 months, and 12 months. Really, really interesting here. The first next 3 months, very choppy, right? April through what was that, July? Some of the biggest market drops in 2022. That's very typical, very normal. Only half the time do you see a positive result during that period of 3 months. Next 6 months, though, things start to sway. Things start to get a little bit more bullish. 75% of the time, next 6 months are actually positive. Now, I don't think we saw this in 2022, but I definitely think we saw the next 12 months be very bullish. And this has worked out 100% of the time since 1983. So when the Fed starts raising rates, it does create short-term volatility, but it also creates a 12-month or a longer term opportunity. Same thing can be shown for the end of rate hike cycle. So we technically have ended our cycle here. And what typically happens there, you can see the zero marks the last hike. And what does the S&P typically do? The average here, about a 10% move over the next 12 months, which we have seen. I don't know the exact number, but we definitely saw a very positive move over the last year. There has been one down year, but typically when the rate hikes stop, the markets return positive. And then what happens when rate cuts happen? When rate cuts finally do come, you can see here the average S&P 500. If we don't go into recession, is very positive, and then if we do end up going into a recession and the headlines are right, it's actually not that bad. 10% drawdown from the index peaks, not too crazy. I mean, we saw 20% this year already, but overall pretty choppy. But an opportunity here to buy on these dips which we actually did. And I don't know if this lines up perfectly. I need to finish drawing my little chart here. But it probably is pretty timed up perfect with this chart as well, where we did buy that dip there. And there's endless amounts of seasonal data. It can be a data dump, it can be overload. I like to stick to a few basic ones to help just give me a general guideline when I'm doing my starting points. I don't use it. I don't blindly trade seasonality. I don't just say, oh, it typically goes up in December, so I'm going all in on December with all my margin and all options. I would never do that, but I do get a good feeling. Hey, markets look good, trends look good, news is good, and typically December seasonality is good. Okay, I feel very confident about the taking trades in December, if that makes sense. So let's look at some other data here, just a couple more, and then I'm going to cover three stocks that typically go up in June. I'll give you the exact tickers, dates, when to enter, when to exit, and how much they typically go up. And then you guys can place your trades based on that. So if we do a deep dive looking at summer, what typically happens with from Memorial Day to Labor Day. So we're in that period now. Well, if you check out this, during that period, our median performance is a plus 3.7% return. So people say sell in May and go away, which is true. May to the Labor Day can be a little choppier, but it's typically a positive time, not by huge amounts, but there's a lot of opportunity here. 72% of the time, the markets are positive during the summer. So that's why I say I don't believe in the old saying sell in May and go away. I just think be more selective, maybe be smarter about your position sizing. Typically from May through the end of the year, up 4.3%, positive three quarters of the time. And down, what is this? Oh, if we're up year to date going into Labor Day, gotcha. Positive 74% of the time. For down year to date, it's only positive two-thirds of the time, but we are up year to date going into Labor Day, or we were, I should say. So this is the stat we should be looking at here. Normally the markets finish higher throughout the year. And then here's another stat to kind of go with that. If we look at the first 2 months versus the rest of the year, often called the January barometer or Q1 barometer. So when the S&P gains during the first 2 months of the year, January and February, it tends to build on those gains for the remainder of the year. So as you can see in this chart, S&P's median gain when the in 25 prior years when it was up less than 5% was 10%, positive returns 80% of the time. So this is what happened this year. We had S&P growth from January through February. It was not greater than 5%. It was less than 5%, but it was up. So what typically does that mean for the rest of the year? It means 80% of the time you finish higher from there with an average return year to date 10%. So that just shows you we still have a lot of, if this seasonality pattern holds up, there's still a lot of room for growth here through the end of the year because what are we up year to date? Does anyone know off the top of their Let's see. Year to date, S&P is up 0.8%. It's not even a full percent. So if this one were to hold true, and it's not going to hold true down to the decimal, probably not even down to the exact percentage, but that shows that there is upside left here based on this seasonal pattern. How many times? This is an interesting chart here, an interesting seasonal chart. People might be saying the market peaks already happened for the year. Yeah, we're going to chop, but we're not going to make new highs. Well, as you can see from this chart, it's very uh, not typical for the markets to stall out mid-year, especially during these summer months. So here, these mark how many times the year high was in each month. So January is typically when you might see it, but we hit new highs in February. And then typically when that happens, markets don't stall out. They keep going higher, and the all-time highs for the year typically happen in December or at the very end of the year. So for me, seasonally as well, makes me feel bullish that we won't see the year's highs this summer. We may see all-time highs this summer, but I don't think the market's done from there. I think we're going to go further into December. Well, I shouldn't say that exactly yet, but I think further into the year than what has already happened previously. So again, history doesn't always repeat, but it often rhymes, and we can use these patterns and this data to help give us a guide in our analysis of the markets and what to expect. It doesn't override everything. It isn't just the only thing we look at, but it is a factor that we can consider when taking trades. And again, following that presidential seasonality pattern, we've done very well, as well as a few other patterns like the sectors. Those are really helpful to breaking down the stock market. Now, I take in dozens of market patterns and seasonality factors to get a gauge on where I believe the stock market will head next. And I also do it for individual stocks too. I pull a report each and every month that shows what stocks go up every year on the same dates. So over the last 10 years. So you can see here, get ready to write these down or take a screenshot. Tesla typically goes up from June 3rd. It's an 18-day hold, so that would be June 3rd through June 21st. And that's about a 10% return on average for Tesla. Timing is pretty good there on Tesla. I don't know where it's at the moment. Let me go ahead and pull it up. Tesla's up today, of course.
Of course.
Of course it is.
It was up. It was up actually up a good bit more, but it faded with everything else at the open, and now it's trying to bounce us back.
So let me just pull this up here. So Tesla's our first one to look at. Obviously, short term, good trend. Newton momentum is bullish. Uh, Broke above the 200-day moving average. It's up about 50% from the lows when Nate and I called it. Hopefully, you guys took it. Jack's been trading Tesla too for some good wins as well. But what this pattern shows is that from June 3rd till June 21st, which will fall on a weekend, so June 20th, about a 10% return in Tesla from here, which would put it right about here at this 400 number. So that's
Which I mean, technically would be very reasonable from kind of where we sit right now too. So that lines up.
absolutely. So you guys can see there, that is a typical seasonal pattern from where it is now to where my crosshairs are there on the screen are. So if you want to trade Tesla, write down June 3rd, 18-day hold time, and then about 400 for your profit target based on today's price. Now, you may want to rerun that number when June 3rd rolls around and get a more accurate reading, just ideally where it could go. Now, if I were to trade this, I would look to do an elite spread, and I wouldn't want the full 10%. I don't want to be too greedy, but I might look 5% out of the money to then get an outsized return on this typical move. Next stock up is Carvana, which I hate to bring up Carvana because I had a ton of Carvana, bought it at 200 and sold at 220 and thought I was a genius. Well, let's go look at Carvana now.
Hey,
Here's
good
Carvana now, 319. Oh,
good little dip today, Graham. You're you could only be down $110 from where you would have wished you exited if you got on this nice 0.3% dip today.
yeah, I bought right about somewhere in here and then sold it right about here.
Uh, Graham and I got to connect with a gentleman not too long ago who I believe is holding several million shares of Carvana.
Yeah.
So that was a good meeting, but that was before Carvana really took that second leg and rip. So he's probably a lot happier now than when we were doing our meetings with him.
Yeah, I think he manages like $3 billion.
Yeah,
His top two holdings are Carvana and Meta, if you guys
yeah,
are curious.
yeah.
So that's what really turned my eye towards Carvana, especially on this dip. He averages 16% annual returns over the last like 20 years. So he's pretty good at picking stocks. His two picks were Carvana and Meta, and boy, oh boy, am I jealous of him right now.
He was actually headed down to the like Carvana Investors Conference when we right after our meeting. So they must have said some good things at the conference because ever since then it's been an absolute beast.
Yep. So if you guys are interested in Carvana, well, here's the seasonal dates for it. It's gone up every year on these dates for the last 10 years. Now, I'm not sure if Carvana IPO'd previously in 10 years, but for the data we do have, entry is on June 6th, typically a 22-day hold time. So that would put your exit about June 28th. And it's gone up a measly 35% on the underlying stock during that period, which is just nuts. Now, I'm not saying we're going to get 35% this year, but I think it'd be reasonable that we get 10%, especially considering that that's very normal movement for a stock like this. It's a little more volatile. It makes bigger moves. I mean, look, in April, it was at 160. It's at 320 now. It's doubled since April. So to say that Carvana you could expect around a 10% move, seasonally speaking, obviously no one has a crystal ball. That would be a pretty good gauge of where you might see that one going. So ticker number two is Carvana. Ticker number three is Meta, which was the other one that I just mentioned that $3 billion hedge fund manager. It's one of his top holdings right now. His top two U.S. stocks are Carvana and Meta. That's also a seasonally strong stock in June. The entry date for this one is June 18th, and it's a 24-day hold time. So that puts you at July 12th. So June 18th to July 12th, Meta typically gains about 4%. Now, there's a lot more stocks that we could cover today, but obviously we don't have time for that. But I did want to give you guys my top three for June that you guys can have. Write them down for free. We'll probably end up trading them in here in the opening playbook as well. I typically cover this kind of information every Tuesday at 10 a.m. Of course, we do the show every day at 10 a.m. Now, Jack, who just logged into the room, who I just mentioned was crushing it on Tesla and some other trades, he actually trades a similar method to this too. Jack is the income ace. He takes an income approach to it. And Jack, I pulled this from your one-click members portal. You're on absolute fire with trading the seasonal patterns on stocks.
Yeah.
The 84% win rate on live trades so far sent out to members just like you. And they're really, really great uh, premiums you're getting there as well. And if you look at the average annualized ROI, obviously this is with options. Jack, that's a pretty tough number to beat. 218%
Yeah.
on
It's
the
not a
annual.
bad sandwich.
No, not at all. And I really am excited to bring you on. We were just talking about how volatility tends to spike
Yeah.
here going into the summer.
Yeah.
That's a great time to be collecting premium, selling
Yes.
options, finding ways to generate income with more overpriced options, which is where it kind of perfectly fits in here. We're talking seasonal patterns and then how to generate some income on them. So, Jack, I'm glad you were able to join us here today.
Thank you. Yeah, me too. This has been amazing. I love your seasonality. I was watching you go through that. And sometimes it's interesting how even if the market's not making new highs, there's all kind of volatility bubbling right along the surface. And I
Right.
think that's what we're going to see this summer because, we got a guy that wakes up every morning and wants to see how many waves and ripples he can cause. And this is a whole new thing for me. I got to tell you, I've been 40 years in the market. I've never seen where one guy can open his pie hole and move things as much as he does. It's amazing. So that's why I think we're going to see the volatility, even if we don't see the new highs. But I love that seasonality stuff you brought up.
Yeah.
That's like a kind of like a little unfair advantage. You don't want to go rushing in when you see that kind of seasonality data. So that's great information for everybody tuning in.
It definitely is. And Jack, I'm excited to hear about what you got dialed up. And I know you have a trade today that's going out, just went out. I'm not sure. But today, guys, a huge, huge opportunity that you need to know about and be prepared for in June. So I'm excited to talk about it. Now, you've probably heard the old expression, sell in May and go away. Well, for fund managers and retail investors, that couldn't be further from the truth. I just showed you multiple times. It's typically a good time to be involved in stocks. And that doesn't mean buy every stock out there. But in June, we'll see these big money investors rebalance their portfolios and spread money around to stocks that they believe are about to move.
Yeah.
And my special guest today is about to share some groundbreaking research that could tell us exactly what stocks they'll be buying like crazy. And it all starts with a simple question. Think about this, guys. What would you do if you knew that you could have placed a trade on Microsoft every year on October 13th and had the chance to pocket $1,000 or more in a matter of days? Every year, Microsoft, October 13th, makes some money. This didn't work just once, not twice, but it worked for an entire decade and it generated winner after winner for 10 years straight. All you had to do is wait for October 13th to roll around on the calendar, circle that date, then place a quick trade. Now, here's what it could have paid in 2023, $1,677, just like it would have year over year for an entire decade. Every single year with Microsoft on October 13th. Now, that date's coming up, so you might want to go grab your calendar now and just punch in Microsoft on October 13th. Now, this is all thanks to a breakthrough discovery by one of the world's top income experts, a man who was trained on Wall Street, having moved billions of dollars as a NASDAQ market maker. And he's since taught tens of thousands of folks across 40 different countries. And today he's revealing this phenomenon to you, showing you how you can tap into these repeatable income opportunities every single year on the same exact dates from your normal brokerage account. But that's not all, guys. Over the course of the next few minutes, like I said, we have a bonus here. He's going to give you 10 of these repeatable income opportunities for free. He's going to give you the entry date. He's going to give you the ticker for each one. So if you enjoyed those last few picks, you're going to love what he has here. That means by the end of this broadcast, you'll be armed with 10 trades to start targeting income from stocks this very year. From the same stocks that have shown the power to pay upwards of $1,000 or more on the same exact calendar dates year after year for the last 10 years straight. So everyone give a warm welcome to the man behind it all. Jack, it's great to have you on here today.
Hey, thank you, Graham. I'm thrilled to be here. Great seeing you, Nate. And today I want to unlock an unbelievable opportunity in the stock market. This is a way for the average Joe to tap into this repeatable income method on the same dates year after year. And all you have to do is check the calendar. And once you decide the trade is right for you, place a quick trade. Then go enjoy your life, knowing that this special type of income trade has shown the power to pay right around $1,000 every time these specific dates rolled around. Just like Apple, write it down every year, June 30th. Here we go. Now, let's say somebody had 5,000 invested. That's the amount I'll be referring to today with every example. You don't need that much, but that's what we're going to talk about. Now, what would you do if you knew that every year on July 1st, you could have taken a few minutes out of your day to place a quick trade on Apple, waited a few days, and watched as north of $1,000 came pouring into your account for 10 years in a row? 2014, 15, 16, every single year it's there with profits so big it's got a comment in it. Now, would you take the trade this year?
Well, Jack, I think I'd be foolish not to take that trade. Where else can you have scooped up an extra $1,000 with really hardly any effort?
Well, that would have been the right decision. Because had you followed along this last year, you would have collected an extra $3,039.22 in income with just a few clicks of the mouse. Right on July 1st, $3,039.
Love it.
And as great as it would have been to pocket that $3,039 this last year on July 1st with Apple, that's not what has me most excited. You see, this repeatable income trade, it doesn't occur on just one stock per year. This phenomenon happens with a few dozen stocks throughout the year on the exact same calendar dates, generating winner after winner for 10 years straight. And I call it the income calendar. And anyone with a regular brokerage account can start using it today. Now, before we get going, though, I want to be very clear. There's nothing guaranteed in the markets. There's no instant income magic pill. So do I lose from time to time? Of course I do. Who doesn't? Anybody tells you they don't have losses is not being honest with you. But that's why my team and I spent countless hours researching and invested hundreds of thousands of dollars into the income calendar to make sure that nothing else even comes close.
Well, Jack, I know you're a humble guy, but let's face it, you may have the most impressive track record in our industry. I mean, you ran your hedge fund so successfully that it never saw a down month on record, not even one. And just recently, you logged a remarkable 96% success rate on over 100 published trade signals in one of your sister services. And you've also been able to help some top performing folks across the country from all your services, all in here. Count has grown $1,200. No losing trades, 5 for 5. Richard G said, Jack, I've been one of your members for about 6 months now. Your record is 100% since I've been a member. And then there's Jared, who wrote in, made about $2,600 getting in and out of Amazon this week. Good stuff.
Hey, those types of results blow me away. And speaking of Amazon, that's on the income calendar too. Here you go, every year, July 1st for 10 straight years. Now, if there was ever a time, though, that I thought the income calendar would fail, it would have had to have been this last year, 2024. Going into the month of July, things were not looking so hot for Amazon. Even though the tech sector was booming, Amazon was the ugly stepchild, barely moving through the sluggish summer months. Now, most folks I know would have picked any other tech stock and avoided this one like the plague. But I'd bet that 99% of the world had no clue that every year on July 1st, Amazon paid for 10 years in a row. Amazing data. And sure enough, add 2024 to the list as well, because after just one quick trade, you pick up $2,388. That happened in 7 days.
That's amazing. That's $2,300 in 1 week, nearly double what the average person brings home in a single week. Now, if you think about that, over the last few years, we've watched the cost of everyday expenses skyrocket. Energy bills are now over 20% more expensive. Cost of a new mortgage is actually up about 70% in the last 5 years, but up 47% there since the interest rates started. And even the cost of eggs have gone through the roof. The damage caused by inflation is just horrible right now. And even if you got a raise last year, it probably doesn't feel like it's making much of a difference at the end of the day. In fact, in some states, we're looking at as much as $13,460 in added expenses each year for everyday hard-working Americans. People are getting squeezed. Now that's more than $1,000 in added cost of living each month.
And I can't even imagine the stress that adds to the day-to-day life for most folks. That's an extra 1,000 a month minimum out the door. So forget about booking the Saturday morning tea time or taking your family to that restaurant they all love, because right now every penny counts. Hey, but by just glancing at the income calendar, then placing a quick trade on Amazon, you could have pocketed an extra 2,388 in income in just 1 week. That's more than enough to cover the ever rising cost of living for the month and still have $1,000 left over to stash away in the emergency fund. Now, you might be wondering, this is smoking hot. Are we buying options to see these returns? No, we aren't. Because if we were buying options, we'd only be able to profit if the stock goes up significantly every year. Luckily, with the income calendar, we don't even need the stock to move to make money. That's a great benefit. Now, take a look at AVGO, for example. There it is, 10 years in a row. Now, I mentioned that it's setting up for a super cycle right now. According to the income calendar, this is a big payout, but it's also paid out every year on October 11th without failing even once. Now, you might think of 2023 as the year of the chip stock, but October was a different story. AVGO shares had plummeted since September. And at the time, China had American investors panicking about a chip crisis. But on October 11th, AVGO came up on the income calendar. And all you had to do was place a special type of trade to take advantage of it. And sure enough, over the next week, it wasn't much different. AVGO made a little move, but not much. It didn't even go up a full percentage point. And folks who had invested in the stock would have seen a measly $11 profit. But folks using the income calendar would have cashed in with a chance to pocket $3,032 in extra income. That's what you want.
Jack, that's really something. That's more than 200 times better than buying
Yeah.
a buying stock. Let me say that again, guys. 200 times better. And you didn't need AVGO stock to shoot to the moon to see it happen either.
Hey, those are the types of results my income calendar could have produced for anyone following along. And that's why I'm giving away my 10 most reliable setups for free today, plus a few bonuses. Now, in just a few minutes, I'm going to give you everything you need to get started right away, so that by the end of this broadcast, you can jump in on the next opportunity on the income calendar. Because it doesn't matter what the media is saying or what the White House is saying or what Wall Street is trying to shove down your throat. Here it is. All that matters is this. All that matters is that you can place a quick trade on these specific calendar dates before the market closes that day, and that's it. Then go enjoy your life. Maybe take your kids or grandkids or go yourself to Disney World. It's a fun place. Or maybe go helicopter skiing up in Blue River, Canada, like my buddies and I like to do. That's a blast. Now, look, the opportunities are endless. But unfortunately, what most folks don't know could be killing their profits. You see, the reason a lot of traders struggle to see consistent returns isn't because they're a lousy investor or dumb or anything like that. It's because as humans, we're naturally swayed by fear and greed. That's why sometimes, even if everything looks right, you could be tricked into buying a stock destined to head lower and lower. But with my income calendar, we're able to flip the odds in our favor, only trading stocks that have historically paid on the exact same calendar dates every year for 10 years in a row without failing even once. Just like Walmart every year, November 3rd. Now, in early November last year, Walmart was on a serious tear. The stock was up nearly 10% over just the last month, and all the popular indicators were screaming that the stock was overheated and due for a pullback. By November 3rd, Walmart had hit the top of the Bollinger Band range and started heading lower. And the RSI was pushing up to the 70 selling level, meaning the stock needed to cool off for a bit. But on November 3rd, Walmart was on the income calendar. And just like with every example I'll share with you today, when it's on the income calendar, that meant one thing and one thing only. It meant Walmart had paid out upwards of $1,000 or more on that same date, 10 years in a row without failing even once. And all you had to do was take 2 minutes to place a trade, and that's it. There's no need to watch the stock like a hawk, no need to constantly refresh the charts, and certainly no need to bet the house to make a half decent return. Because sure enough, over the next few days, while Walmart stock barely ticked higher, you would have picked up 12.50.
Jack, that's awesome. That's a significant amount of money. I mean, the average cost of a new car payment, last year was a whopping 735 bucks a month. But this one trade on Walmart could have covered way more than that without trying to time the market or throwing up a prayer on some risky penny stock. Now, it's those type of results that get me so excited about this incredible opportunity today. And for folks to finally get ahead without spending countless hours banging your head into a brick wall, trying to find the next home run investment. And in the case of Walmart, after just a few minutes of your time, it would have been another steady win. Like we've seen from the study year over year on November 3rd for the last decade. Look at some of those results:
Yeah.
1,024, 882, 1,410,
Yeah.
2,143 over and over again.
Hey, that's exactly right, Graham. Those trades had a comma in them. They're so big. Now, look, what nobody has a crystal ball, right? And I could never guarantee a future outcome, but think about this. Just think here right now. Wouldn't it be nice to only trade opportunities that have historically shown to have paid with 100% accuracy over the last decade? Yeah, that'd be nice. Now, think of it like this. During the summertime in South Florida, even right now, I could pick pretty much any day in August and bet my bottom dollar it is going to be hot. It's already hot, probably in the high 90s, if not the low hundies. It's hot this year. Now, every once in a while, right, we might catch a cooler day, but far more than often, I'd be right. And it's the same thing with the income calendar. We're using a full decade of data with 100% accuracy over the last 10 years to find the next opportunity. An opportunity that's shown the power to pay 1,000 or even more on the exact same calendar dates every single year without missing it even once.
Well, and Jack, you've already shown four income opportunities that people can use each and every year. We had Apple there, 3,039. Amazon next, 2,088. March here, 3,000 bucks, in November there with Walmart, 1,250. And I really hope that folks watching right now are writing these dates down because so far all of these examples have shown the power to pay north of 1,000 bucks. Now, I realize you're no stranger to showing folks these types of returns from your work in the past. Michael B. here from California says, I have so much confidence in your system and experience that all have been successful so far, currently bringing in $750 to $1,000 per week in income.
Mm.
How about Laura P., who has seen a real impact with your help? She said, I'm now bringing in a minimum of $3,100 in premiums every week into my account. I think the biggest week was just under $7,000 in one single week.
Hey, Graham, those stories are some of the very best ones I heard. And I love sharing my income calendar with my top students like Michael and Laura. But first, I just want to let you know if you've missed out on these repeatable opportunities year after year, it's not your fault. You see, these are decade long patterns that I bet nobody knows even exist. You see, for almost all the 20th century, there was a major advantage Wall Street had over Main Street. For the longest time, regular people like you and me had no way to know what Wall Street was doing, what stocks they were targeting, when they were buying them, when they were selling them. Then in 1993, U.S. regulators tried to level the playing field, mandating the electronic data gathering, analysis, and retrieval system, also known as EDGAR. Now, this was a new electronic way for Main Street to see what Wall Street was up to because insiders would have to upload their filings to the SEC anytime they did a trade, and anybody can see this online 24/7. So if a CEO of a publicly traded company was buying a stock, he'd have to file it and everybody would know.
Well, Jack, these Edgar reports were meant to totally change the level of access that folks
Yeah.
had to this kind of information. And I can see how Edgar would be a total game changer for this income opportunity.
Now, in theory, it definitely is, Graham. But unfortunately, that's not exactly how it turned out. You see, Edgar was supposed to be a way for regular folks to see what the big money was doing. But the fact of the matter is, it takes an entire village of people to get through all the filings because every single day there's north of 3,000 individual Edgar filings hitting the SE's website on average.
Well, Jack, I mean, if you're lightning fast with a computer like I am, you might be able to do 50 a day, but there's no way you could keep up with 3,000 a day. And that doesn't even account for the 12 million filings that are already posted on the site.
Graham, it's information overload is what it is. Now, let's face it, though, the big Wall Street institutions have hundreds of thousands of employees. Bank of America has more than 213,000 employees, and JP Morgan has more than 293,000. So for them, I'm sure this resource of Edgar is a gold mine because they actually have the number of heads in the seats necessary to keep up with the filings. But for folks like you and me, there's quite literally not enough time in the day to even get a feel for what's going on. But I knew this was the best shot to see what the big money was doing. So my team and I set out on a mission to do just that. Now, the theory here was that if we could see when Wall Street corporate insiders or private hedge funds were buying up shares of a stock all at the same time, even if they didn't know it, then we could piggyback their investment for what could be an easy win. So we hired professional stock trading engineers to develop an algorithm to automatically analyze these Edgar filings in real time. And we spent over $100,000 in the process hoping to find a stock market loophole. But what we found was not at all what we were initially looking for. It was something a million times better. That's why I get so jacked up. Now, you see, Wall Street doesn't invest like you and I. They don't just invest whenever they feel like a stock should go up or when the indicators align or even when insiders are buying. What we quickly found from our proprietary algorithm is that Wall Street trades on a repeating calendar, investing in the same stocks on the same dates year after year. Just like with PayPal every year, July 1st. Here's what it did 10 years ago. And here's what it did last year, 2,950 on PayPal. And all the years in between too. This is a good payer. And you don't need to do any extra legwork to take advantage of these income opportunities. If you have any normal brokerage account, TD Ameritrade, E-Trade, Schwab, Robinhood, you name it, it works in all of them. All you have to do is check the income calendar and place a trade to follow along if you want to, then go enjoy your life.
Well, Jack, if there's anyone who knows how to get the most out of life, it's definitely you. Now, for you, that probably means spending your summers in beautiful Aspen, where you have a cabin that allows you to unplug and enjoy time with the family. Then in the winter months, it's back down to Bonita Springs, Florida, where you get to fish some more and enjoy the warm winter month with the family on the beach.
Graham, I live a life I could only have dreamt of as a kid. And it's not because I hit the lottery or gambled my life savings on some risky penny stock. Now, look, if there's one thing you should know about me, it's that I'm not a risk taker. I live a boring life, a life of repetition and routine. And while that may sound boring to some folks, I could care less about what people think now. And one of the reasons I'm able to spend my time doing the things I really love to do is because of the hands-free trading method I've been using for decades now. The same technique behind these repeatable opportunities on the income calendar. And in just a minute, I'm going to share with you everything you need to know to get the best results. But before we get there, I still have 4 more dates from the income calendar I want to give away. That way you're completely armed with what you need to start targeting the same opportunities when they roll around on the calendar again this year. Like with Lululemon. Every year, May 26th. Look at those payouts. Now, this past year, though, without the income calendar, I don't know if I would ever thought about touching this stock. In late May, news broke from Bloomberg that a top executive was leaving the company. And that's after Lulu's stock had been sinking like a stone since earnings in April, dropping nearly 30%. Now, that's 2 crimson red flags for the stock. And with that in mind, you could have passed on Lulu in 2023 and just waited for next year. But if you did, you would have missed out big as Lulu paid out again $2,661 cash money.
Amazing. That was just about this time last year, 2024 right there. You guys can see the whole time.
Yeah.
Look at Lulu. Jack, $2,661 by the time Friday hit. It's like getting a second paycheck for the week. And you wouldn't have had to wait years or months to see it. That all happened in just a matter of 3 days.
Hey, it's really something, isn't it, Graham? And as my team and I discovered when initially dissecting the data from Edgar, when the big Wall Street whales all jump into a stock at the same time each year, it creates what I call the income window. Now, this income window is a short period of time where the stock pays out steady returns, just like it has on the same exact dates every year for the last decade. Then we just deploy a special type of trade at the beginning of the income window that allows us to position ourselves to collect what could be meaningful returns from it, usually $1,000 or more from the opportunity.
I love it. So, Jack, are you maybe collecting some dividends during this income window?
No, Graham, this has nothing to do with dividends.
Okay, well, I know you like covered calls. Is this covered calls here?
I love them like a fat kid loves cake, but this is not covered calls either. You see, with those income methods, you need at least 25,000 invested to see even just a marginal return. But with the income method I'm using, you can get into most of these trades with just a couple $100. Now, of course, you're able to invest as much as you'd like in the trade, just like with Abercrombie and Fitch. Here's another one. Now, this is ticker ANF, and it's the same old story every year. When February 2nd rolls around, the income window opens up and the stock pays. And it was no different in 2023. Now, look, you could have listened to all the noise and all the talking heads calling for a recession, spending your time getting all worked up on what the Fed might do next to try to tame inflation. Or you could have just glanced, ignored the nonsense, and just glanced at the income calendar, hit a few buttons on your phone to set the trade on Abercrombie and Fitch right when the income window opened up, then unplug for a little bit. Maybe that means heading out to your favorite winery with friends, or just relaxing, dive into a new book, or listen to a podcast. Because sure enough, by the end of the week, you could have collected another healthy winner. This one, 3,620 without even breaking a sweat in 7 days.
Yep, right there, 2024. Yeah, perfect.
And that's the power of these income windows. And that's the type of opportunity I want to pass on to anyone tuning in today, because my income calendar marks down each and every one of them well in advance.
Well, Jack, your income calendar is exactly what folks need right now. And I have to say, it's really unlike anything I've ever seen before with these results you're getting. Again, guys, on the live trades, 84% win rate here, just crushing it. 218% average annual return. That's nuts. Now, look, I've worked with a lot of our experts, but I've never seen anything quite like this consistent. I mean, 100% success rate over the last decade. I have to wonder, can you even lose?
You can lose. Of course you can, because no strategy wins all the time. But remember, past performance is never an indicator of future performance. And even Wall Street isn't on the winning side 100% of the time. And that's why I deployed a risk-cutting method I learned nearly 10 years ago. This is a special type of trade during these income windows that allows us to collect even if the underlying stock goes slightly against us. Now, take a look at JPM on May 13th every year, for example. As you can see, it's paid 1,000 or more every time this calendar date rolls around. It's a good payer. But in May 2024, something unpredictable happened. Just as we reached the end of our trade, JPM shot lower out of nowhere.
So, Jack, did you probably lose money on this one then?
Nope. As a matter of fact, while most folks invested in JPM stock were licking their wounds, with my way of trading, anyone following along could have collected $3,103 in profit during the income window.
Jack, $3,100 even after JP Morgan stock fell. This just keeps getting better and better.
Yeah, now I'll tell folks all about this special type of trade in just a few minutes. And no, we're not selling risky naked options either. Like I'll show you in just a moment, collecting this income isn't any harder than shooting a layup. Doesn't matter where you live or who you have your brokerage account with, or if you've been trading for 35 years like me, or if you're just getting started. You just have to know which trades to place. And I'm going to show you everything you need to know to start using it with the income calendar today. You see, I've already hosted a live step-by-step workshop to show you exactly how you can start targeting from these payouts from the income calendar. This includes the full details from how to place your first trade to how to manage your risk so you can start using this technique in your account today. And I'd like to invite you to join here for free today. And once you get your hands on this step-by-step video course, you'll be shocked at how clear-cut it really is. And I'm going to show you everything you need to know to start using it with the income calendar today. You'll immediately be able to start using it on the 10 trades I'm giving you today in this broadcast, just like with the next one. This is Fortinet, ticker FTNT. Every year on February 1st, this bad boy pays out. Here's what it's done for the last 10 years. Look at those profits. And if you wanted to take advantage of it this last time it rolled around, all you have to do is select the trade, then send it off, and then it's back to your normal day.
And of course, any regular brokerage account would do the job, right, Jack?
That's right, Graham. In fact, the government even allows this strategy to be used in retirement accounts. And sure enough, just a few days later, you could have pocketed $3,478 on Fortinet. Now, in this case, you could have done it with Fortinet during the February 1st income window. But like I mentioned earlier, this decade-long phenomenon has shown the power to pay on a few dozen stocks throughout the year.
Well, the potential really seems endless. I mean, today you've given us 10 of these trades right from the income calendar that folks could start taking right away. And in case you missed it, guys, here's the dates if you need to write down them or take a screenshot. Apple, June 30th, Amazon, July 4th or July 1st, Walmart, November 3rd, on and on and on. Take a screenshot right now. Now, all in all, Jack, we're looking at the chance at an extra $14,227 over the year after just those 10 trades you showed us. Can you guys imagine if you had 20 of those types of opportunities or maybe even more?
Well, Graham, the good news is there's even more opportunities available right now as we speak. And that's why I agreed to sit down with you here today to share them with the world, to show people how to use the income calendar to help radically boost their income. And today, the folks out there can claim access to this recorded workshop so they can start implementing this strategy in their own account just by subscribing to my Red Hot